We have a few more minutes here for people to join. Looks like we have most of the people who RSVP'd here on the webinar. So thank you guys for joining us today. A couple of housekeeping items before we get started here. Our presentation today will cover the topic of Social Security, and Kevin Hansen with the Principal Financial Group will be the one covering the bulk of the presentation, but also Compass Advisor and owner Guy Lehman will kind of wrap things up and fill us in on how the topics that are discussed today might fit in with you and your personal financial plan and your financial goals. So there will be a brief Q&A at the end, and if you do have any questions as we're going through, please feel free to email me. My email address is right there at the bottom of the screen, caleb.pearson@compassiowa.com. And just as a reminder, we will be recording this presentation, so if you want a copy for yourself to rewatch, or if you want to share it with anyone, please let me know. I will send an email with a link to that. We're also going to put it on our Facebook page. So after the presentation, you'll get another email from me with a link to be able to view it again or share it if you'd like. So with that being said, here, before I introduce our speaker, I'm required by our industry to read the disclosure that's at the bottom of the screen. Feel free to read along if you'd like. Principal Financial is not affiliated with Compass Financial Services or LPL Financial. Securities offered through LPL Financial, member FINRA and SIPC. Investment advice is offered through Compass Financial Services, who's a registered investment advisor and separate entity from LPL Financial. So now I would like to introduce our speaker for the day, Kevin Hansen. He's a director of advisor consulting at Principal Financial Group. Kevin is a certified financial planner who is responsible for developing and delivering educational content on a broad range of financial topics. That includes topics like this: Social Security, also Medicare, education planning, and 529 plans, as well as advanced tax planning and distribution strategies. He has 32 years of experience in our industry. I was talking to him before we started this webinar. He was actually an advisor for a while as well, and he's been with Principal since 2004. So Kevin, we'll go ahead and switch screens over here. Let me stop sharing mine so you can share yours.
Perfect. All right. Caleb, if you could confirm that you see that slide title.
I do not see anything yet.
Okay, my apologies. Here we go.
There we go.
Great.
Perfect.
How's that looking?
Good.
Super. All right. Great. Well, thank you very much, Caleb and Guy, for having me. It's great to be with you all. Thanks for joining us to talk about a topic that generates a great deal of interest for folks who are either in retirement or on the doorstep, and folks who are planning for retirement income down the road. There are a lot of moving parts when it comes to the topic of Social Security, something that seems to be pretty basic, right? Pretty pedestrian topic. How difficult can it be? You know, it's something that, you know, we work, we have a little piece of our earnings withheld, and that's going to build up our Social Security benefit. When we go to retire, we pick up the phone, we call the fine folks at the Social Security Administration, we turn on our benefit, and then we go. We're off and running. Well, it's not quite as simple as that. We're going to talk about a number of aspects of Social Security here over the next 30 minutes or so, and things that for you, if you haven't yet elected benefits, that will help you understand and help you put your best foot forward when the time comes. If you are already collecting benefits, and I understand there are always some folks who are attending this just to get some additional knowledge, we'll talk about things like the taxation of benefits and some other things that may help even while you're currently collecting. Spousal benefits is an aspect of Social Security probably that I get the most questions on for a couple of reasons. Number one, there are a lot of rules around spousal benefits. There's an entire bucket of rules that impact how and when one can file. If there's a marriage and a spousal situation in a household where you may be able to elect benefits on your own earnings record, or you may be able to receive a bump up because of the benefits of your working spouse. So real quick, and I look forward to your questions. Please do not hesitate to jot something down if we're going through this and you think of something. In all likelihood, if you have the questions, somebody else on the line does too. And the part of this that I enjoy the most is answering questions. So I've had the opportunity to talk about Social Security for over 12 years now, the topic specifically. I've been in the industry for over 30 years, and I know that there are so many different things to consider when it comes to building a retirement income plan, and Social Security is a big part of it. It's been around for a long time. This slide, it dates back to 1935. The Social Security Act was signed, and at the time Congress intended and did create what was viewed as a safety net, right? Social Security was never intended to be our primary source of income in retirement. Unfortunately, for a lot of folks, it kind of ends up that way because of some, inability to save adequately, some maybe job situations that have derailed their plans, and maybe inability to work with an advisor to help them along the way. Along the route here of Social Security, it has gone from what was a very basic program, that basic safety net, effectively with provisions for supplementing retirement income, to a program that has over 2,000 different rules that can impact how and when you file and how much you're going to receive. Medicare was signed into law in 1965. Full retirement age, FRA, as you see there on the slide, full retirement age is important. We'll talk about that a bit here in a moment. That was bumped up the year after my dad retired. He retired in 2008. His full retirement age was 65 in a few months, and full retirement age for anyone born from 1943 to 1954 has a full retirement age of 66. Those of us born in 1960 and later have a full retirement age of 67, and it matters. It impacts some of the things that you can and can't do, particularly with spousal benefits, and we'll talk about that as we go here. Eligibility, basics here fairly quickly. You can file and collect benefits as early as age 60, and that's for Social Security retirement benefits. If you are a surviving spouse, you can file to claim what's known as a widow's benefit or a survivor's benefit as early as age 60. Even earlier if you have dependent children in the household. There's so many different paths we could go down here, but for the sake of our session here today, we're going to keep it kind of within the limitations here of time, and talk about retirement, Social Security retirement, and we'll talk a bit about Social Security survivor benefits as well. You need to have worked, and you need to have what Social Security refers to as 40 credits. Sometimes it's referred to as 40 quarters of coverage. I tend to use the word credits a little bit more because when I think of quarters, which is kind of the traditional Social Security accrual concept, I think of a calendar quarter, a period of time. My apologies there. My puppy's here's somebody at the door. I think of a calendar quarter. A credit is earned for the amount of work that you do. You can earn a maximum of 4 credits in a year, and you have to work at least on a part-time basis, for 10 years in order to be eligible for your own benefit, but you can certainly be eligible based on a working spouse's benefit as well. We'll talk about that some more, and the calculation of the benefit. There's often misunderstanding there. I know oftentimes people maybe perceive that the calculation of Social Security may be based maybe on my last 5 years, my last 10 years of work. That's not the case. It's based on your highest 35 years of earnings. This is a snapshot of the Social Security website here on the right, and in the background there is a photo of a kind of traditional Social Security benefit estimate statement. For those of you as old as me and maybe a bit younger, you recall a time when we used to all get our benefit statements in the mail. They'd come about 90 days before our birth date every year, and they would provide some very important planning information. You can access that information online very, very easily. If you haven't already done so, I would urge you to sign up for a My Social Security account. You can go to ssa.gov, SSA for Social Security Administration.gov, and on that home page, the landing page, you can click on My Social Security. It will walk you through the easy steps to set up an account to be able to access this planning information. Retirement income, certainly, and Social Security go hand in hand. The folks at the Social Security Administration tell us that for the average income earner who is looking to replace 80 to 100% of the income that they were earning during their working years, they'll be relying on Social Security to make up about 40% of their income in retirement, right? 40%. It's no small slice of the pie, right? Yet they also inform us that based on their data, 74% of people who are collecting a Social Security benefit are receiving a reduced amount. What does that mean? That simply means that a large percentage, over 70%, have made a decision to file early. Filing early results in a reduced benefit amount, and that sometimes is known. Oftentimes, they don't necessarily have a choice, but understanding how it works and being able to, as I said earlier, put your best foot forward when it comes to making these decisions is really what our conversation today is all about. I mentioned full retirement age. You can see from the slide here, as I indicated, full retirement age for those born from 1943 to 1954 is age 66. There's a slow increase to the point where in 1960, birth dates in 1960 or later, full retirement age is 67. Waiting to file at full retirement age provides you with what the Social Security Administration refers to as your full benefit, your unreduced benefit. Now, there is a benefit for waiting beyond full retirement age. There is a claiming reduction for filing early. You can see here, if you are in that first group where you were born prior to 1954, you could file as early as age 62. If you choose to do that, your benefit would be reduced by a straight 25%. As full retirement age escalates here in the coming years, with people who are approaching retirement age, the reduction for filing at age 62, the earliest age to claim, increases to 30%. So it's a little bit more of a haircut, as you might say, and that doesn't mean that it's a bad idea to file at age 62. It means that you need to understand that there's going to be this impact. I can choose to file until as late as age 70. Okay, there are many reasons why I might do that. There's certainly there could be just as many reasons why I wouldn't want to do that. The impact of that decision is that I would be in a position to collect the highest monthly check from Social Security if I wait. Also, by waiting, There's no penalty for employment. I may choose to continue to work. I mentioned my dad earlier. I grew up on a farm over in west central Iowa, and he continued to have earned income after he filed for his Social Security at age 65. He wasn't penalized for that earned income. In fact, he was paying into the system on that income, and he did notice a slight increase in his Social Security because he had some fairly higher earning years later on that replaced lower earning years earlier. Now, it doesn't make a big difference. In fact, it's almost always less than a normal cost of living adjustment, but that is part of how the system works. The benefit is an 8% per year delayed retirement credit. That delayed retirement credit comes from full retirement age up to age 70 if I choose to wait to turn on that benefit. And so the big question is, obviously, when should I file? When should I take my Social Security? This visually shows you just kind of the impact of filing early versus the impact and the benefits of waiting until later. There's also oftentimes a question of whether I may work after I've turned on my benefits. For most people, this question is pretty easy to answer. Most people don't turn on their Social Security before they stop working, right? But oftentimes, and I talk to individuals often who they make plans to retire. Maybe they retire from what they're currently doing, and then they get the itch to go back to work. Maybe they get an opportunity. Maybe they're in consulting type work like I do, that it's quite easy to maybe transition into retirement. So maybe instead of stopping work entirely, I can go to work for some place that might provide me half-time work, certainly making less money. But the way the Social Security provision goes, if I'm under full retirement age, and if I've turned on my benefit, there's going to be a limit to how much I can earn. Okay. This year it happens to be an amount of $18,240. Okay. This provision that we refer to as the earnings test impacts me in only two scenarios. One is if I've filed to turn on my Social Security benefits early, so prior to my full retirement age. And in addition to filing early, if I've continued to work and have employment income in excess of this $18,240 amount. If those two things are in place, my Social Security benefit will be reduced. In fact, it will be reduced $1 for every $2 that I earn over $18,240. Okay, and just to shake it up a bit, to add some complexity to keep us on our toes, that limit of $18,240 changes, okay? It changes on January 1st of the year that you reach full retirement age. It increases significantly this year. It happens to be $48,600, okay? What does this mean then to me? It means that if I were reaching full retirement age this year, okay, starting on January 1st of this year, I would have been limited to how much employment income I could earn, to $48,600. And once I exceed that amount, for every $3 that I earn in excess, my Social Security will be reduced by $1. Okay. There is no longer any earnings limit once I reach full retirement age. Okay. And one of the things about this provision that I think most people find confusing is that if I'm hit by this, if I'm impacted by this, and again, I'm only impacted because two things are present for me. Number one, I turn on my benefits early, and number two, I continue to work and have income in excess of these amounts. Okay. If I've seen my Social Security benefit then reduced or impacted because of this, once I reach full retirement age, the Social Security Administration automatically recalculates my benefit and effectively adds back in the money that was withheld earlier. This is a reduction by a withholding of the benefit that I will later collect back starting at full retirement age and spread out over my normal life expectancy. So if I reach normal life expectancy, let's say that's for me, let's say it's age 85, then I'll be made whole. This money is not lost, it's withheld. Now, that being said, for most people, in the vast, vast majority of cases, if you know that you're planning to continue to work, particularly if you're planning to continue to work full time, it does not make financial planning sense to file early, to file prior to full retirement age. There are few, if any, scenarios where that makes sense. Even though you'll get that money back, there are taxation of benefits issues that come into play, and it's, for most of us, I think it's fairly easy to plan and to know whether you will continue to work before or after that filing date. Taxes of Social Security is something that often gets confused with this earnings test, where on the previous slide we were talking about a provision that reduces my benefit. Now we're talking about the IRS coming into the picture and determining how much of my benefit will be counted as taxable income. Okay. And this actually isn't too complicated. There's a formula for what the IRS refers to as provisional income. Sometimes you'll see it referred to as combined income. But I need to determine my provisional income. And then the only other thing you need to know is your tax filing status. Are you single or are you married? Right? You can see then from these tables on this slide that, and let's just focus on the right-hand side, married filing jointly, right? If your provisional income is under $32,000, none of your Social Security benefits will be counted as taxable income. Okay? If you have provisional income between $32,000 and $44,000, effectively 50% of your benefit will be counted as taxable income. The slide says up to 50%. For all intents and purposes, for planning purposes, you can really count on 50%, that 50% being very, very close. And then if your provisional income is in excess of $44,000, 80% of your benefit will be counted as taxable income. Don't confuse those 50% and 85% figures with tax rates. Those are actually the percentage of the Social Security benefit that you receive being counted as taxable income when you file your taxes in April. Provisional income is three things added together. Okay, it's your adjusted gross income plus any tax-exempt interest that you might have. So think municipal bonds. Okay, I own some municipal bonds in my portfolio. While that interest that those bonds earn isn't federally taxable, it is counted in this formula to determine provisional income. And then the third and final piece that's added to calculate provisional income is 1/2 of my Social Security benefits. Okay, those three things: provisional income, tax filing status. There you go. You're a tax expert in Social Security. Moving along, the spousal benefits, as I mentioned at the start, it is a confusing concept. It's a concept where there are a lot of rules that apply, and so I'm going to start with the basics. We're not going to dig real deep into this, but if you have questions at all, again, this is a good area to get a good time to get those answered when we wrap up here shortly. Spousal benefits were designed to keep this program, keep the safety net aspect of this program intact. And particularly if you think back, to the 1930s, 40s, 50s, certainly even today, there is a percentage of households that are one earner households, right? I grew up on a farm. My mom, I always looked at my mom thinking this is someone who works extremely hard, right? She wasn't paying into Social Security. She did not have income that was considered taxable in terms of building up her Social Security earnings history. But because the program is designed the way it is, once my dad filed for his benefits, she was eligible to collect a spousal benefit. Okay. Now, let's say she did work enough and built up a Social Security earnings record, but if her benefit was worth less than half of his, she could have received an increase to collect that spousal benefit amount. Okay. You don't get both in combination, but you get an amount up to the spousal benefit if you happen to be someone who entered the workforce later, a stay-at-home parent, classic example, and maybe just didn't have the time in to build up those credits of those higher earnings. In order to collect spousal benefits, your spouse has to file for his or her benefits. In order for you to collect a spousal benefit on them, they have to file. That didn't used to be the case. There used to be something prior to it was what was referred to as the Bipartisan Budget Act of 2015, and beginning in 2016, there were some provisions that changed. Maybe you've attended one of these 4 or 5 years ago. Maybe you've read and you have this concept of claim and suspend. That is no longer available for Social Security. There still is a provision referred to as a restricted application. We can talk more about that maybe in the questions, but the restricted application is only available to those born prior to 1954. Okay, if you were born after that, this process that involves spousal benefits is less complex. Okay, there's still things to consider. There's absolute planning considerations, but that's kind of the basics on spousal benefits. There's also a provision for divorce. Okay, divorce spousal benefits have a few different rules. One is that you need to have been married for at least 10 years in order to be even eligible to collect a divorce spousal benefit. Okay, and where I just indicated with normal spousal benefits that your spouse must file and collect their benefit in order for you to get a spousal benefit, if you're divorced, that's not the case. Your ex simply needs to be eligible to receive benefits, so they need to be 62 or older, as long as you've been divorced for at least 2 years. You can potentially collect that divorce spousal benefit even if your ex has not yet filed. That divorce spousal benefit does not impact your ex in any way. If your ex is remarried, it does not impact their current spouse. So that's divorce spousal benefits. I was doing a live event, but presenting the same topic last year about this time. I was in central Pennsylvania, Amish country, beautiful, beautiful part of the United States, and was in a mid-sized town, and we were in a large room with round tables, and I had my slides up in the back, and I'm going through all this information about divorce spousal benefits. And I mentioned, you have to be married for at least 10 years. And I look out and I see a woman on one side of the room leaning over to make eye contact with what I thought maybe was a friend or somebody, a sister or whatever, on the other side of the room. And there's all this nonverbal communication going on as I'm kind of laying out these issues around divorce spousal benefits. Come to find out at the end of the session that both of these women who were attending this event were divorced. Each had been married for at least 10 years, and neither had gotten remarried, because that's another thing that will impact this. But the unique thing is that they were each married to the same gentleman in this town. They were both exes of they both had the same ex-husband, and they were technically right. So then your question is, well, could they both collect? And the answer is yes. Johnny Carson, who was a comedian, back in the 60s, 70s, 80s, he had multiple marriages. In fact, he had 3 marriages that each lasted 10 years or more. And so technically, each of those 3 spouses could file to collect a spousal benefit. Bear in mind that there's a maximum benefit, even with somebody like Johnny Carson with high earnings capacity. Each of those could only collect at a maximum 50% of his benefit. That brings up a point often I get asked, if if I were a high earner, what might be considered a maximum earner, and this year that figure is about $137,000 income over that. There's no Social Security collection on those earnings. And if I've been in that kind of mode, if you will, for 35 plus years, if I were 66 this year, full retirement age, what would my benefit be? If we're in the room live, I tend to ask that as a question. Give out a magnificent prize, by the way. You'd win a wonderful prize. No, I'm just kidding. No, you're not missing out on any prize here from Kevin Hansen. The maximum benefit, by the way, this year is $3,011 per month. We think of, in terms of planning purposes, most of our conversations involve that monthly figure. And so $3,011, it's a significant benefit, certainly. So one other thing I want to talk about along these lines is a concept with Social Security that I think there's probably not enough conversations, there probably isn't enough consideration given to survivor benefit provisions. Survivor benefits are entirely different than spousal benefits. Spousal benefits have this 50% reduction calculation. That's part of that whole conversation. Survivor and spousal benefits and divorce spousal benefits only apply when both spouses or ex-spouses are living. Okay. Separately, upon the death of a spouse, there is a survivor or a widow or widower's benefit. The survivor benefit is effectively 100% of your deceased spouse's benefit. But again, there are a whole lot of rules layered in there. The one thing I'll say is the only way I would collect 100% of my deceased spouse's benefit is if I were at least full retirement age. If I were full retirement age or higher, I could collect that amount. If that amount was in excess of my own benefit, I could switch over to that. I wouldn't collect both. If that amount is less than mine, then it's gone. I'm not going to collect that. I'll continue to collect my own benefit. And again, you can collect those at age 66 year older. A couple of quick comments here that I think from a visual standpoint can help to understand full retirement age and can help to understand spousal benefits. We've got an example here with Sam and Ann, right? They're married. How would spousal benefits work in their household? I think it can help most to start with the middle column here, age 66, full retirement age benefits. If Sam waits to file at full retirement age, his benefit would be $1,000 per month, okay? If Ann waits to file at her full retirement age, her benefit, she's the higher earner in the household, her benefit would be $2,400. If she's full retirement age. If Ann has filed, okay, Sam would be entitled to a little bit of a pay raise, right? In this example, he could get 50% of Ann's full benefit, so $1,200 at his age 66. If we back them up 4 years, what would happen to those benefits? Again, what we're illustrating here is what would they get if they filed on one of these kind of 3 key ages, knowing that they could file anywhere between their age 62 and their age 70. If they filed as early as possible, which is age 62, Sam's benefit would be $750. That's a 25% reduction for him. Same thing for Ann. Her benefit would be reduced to $1,800. And the spousal benefit, the calculation's a little different. Instead of a 25% reduction, it's actually a 30% reduction of the 50% calculation. In this case, 70% of $1,200 is $840. And then finally, what would happen if they waited? Okay, instead of filing at 62 or 66 or anywhere in between, what if they just let it ride and decided they wanted to wait and turn on their maximum benefit at age 70? You can see then that Sam's benefit would increase with delayed retirement credits from 66, the $1,000 amount grows to $1,320. Ann's benefit would grow from $2,400 up to $3,100 and change. But what's happening with that spousal benefit? It doesn't increase, does it? It's still $1,200. The reason being is spousal benefits, unlike individual benefits, do not earn delayed retirement credits, okay? The most that that spousal benefit will ever be is at Sam or Ann's full retirement age. It doesn't increase with the 8% per year. Real quick here, a couple of filing strategies. I mentioned restricted applications earlier. What this is, again, it is available only to those of us on this call, or those of you on this call who were born prior to January 2nd of 1954, okay? And basically what the restricted application allows you to do is think about this in terms of spouses, right? There isn't really an application of the restricted application in a single earner household, or a single tax filer household, a non-married household. But at full retirement age, if my spouse has claimed, and if I was born prior to January 2nd of 1954, I could do this restricted application, basically tell the Social Security Administration to send me the spousal benefit only and to let my own benefit ride. Let my own benefit go uncollected up to age 70. I get those 8% per year increases on my own benefit. And while I'm waiting, I can collect 50% of my spouse's benefit. Okay, that's the restricted application. It's being phased out as the population continues to age, but it's still available to those who were born prior to 1954. The do-over is basically, and that's a very technical term, do-over. The do-over is something that allows you to change your decision. You can only do this once in your lifetime, and it allows you to essentially reset. If there are any golfers on the line, it's like taking a mulligan on the first tee. You get to re-tee it up, you get to make a different decision, do it over. But to do that, you have to pay back any benefits that you've collected up to that point. Suspending the benefit technically is still available, but not as it relates to spousal benefits. If I'm married, if I choose to suspend my own benefit, this is something I could still do if I'm 66 or older, but it not only suspends my benefit, it would suspend any auxiliary benefits that are being paid off of my earnings record. So spousal benefit would be stopped, and that kind of defeats the entire purpose of the claim and suspend. Couple of comments, and as we think about transitioning here to Q&A. I do get questions quite often about the future of Social Security. Is it going to be around? Do I need to maybe plan for there to be no Social Security? If I can convey, I think anything as it relates to this, I think it's important to understand that we've been here before. Okay, where we are right now is that the Social Security Board of Trustees, in all of their calculations, are predicting that, barring any legislation, the Social Security Retirement Trust Fund will be depleted in the year 2035. And at that point, if that happens, they'll only be able to pay out about 78 to 80% of individual benefits that have been earned. That's kind of a frightening thought, quite honestly. The reality of that is we have been at this point before. I would suggest that our representatives out in Washington, D.C. could walk into the Capitol after their lunch break today and sign 2 or 3 relatively minor changes in place that would push the life of the Social Security Retirement Trust Fund out by 40 years. And those would be a combination of changes, things like changing the cost of living adjustment, potentially increasing the amount of earnings on which I pay Social Security taxes, okay? Maybe removing the cap on that like it works with Medicare, potentially increasing full retirement age, right? This whole thing is, it's really a math problem. And it's not all that complicated. I think Congress realizes that they could make the change. They continue to kick the can. At some point, because of our longevity, right? We're all living longer than we used to, certainly longer than we were back in the 30s. The full retirement age has bumped up 1 year from 65 to 66, and then from 66 to 67. There may be another change in that. Doesn't mean that the program is going away. In fact, I would suggest that all of our elected representatives realize that Social Security is an incredibly popular and incredibly important income source for most Americans, and eliminating it or significantly reducing the benefit would be the fast track to lose their jobs. And so I think because we vote, I think we won't see Social Security going away. Now, will it look a little bit different? Will there be some of these changes? I think certainly yes. I'm going to wrap up my formal comments there, and just suggest to you that we realize this is not easy. Social Security is not a basic program. As you've seen here, there are a number of moving parts that impact your long-term retirement income specific to Social Security. You've already taken the steps to deal with this first point here. You're working with a financial professional. If there's some of you on the line that maybe aren't, maybe you're just kind of dipping your toe into this thing. This and Medicare are two of the things that I deal with a whole lot, and I realize certainly going way back in my career the value of working with a financial professional. And also I would suggest make sure you don't make a decision on Social Security in isolation, in a vacuum or a bubble. All of your sources of income matter. Go online, create that Social Security account. Determine your filing timeline, and then you're off and running. You can apply for benefits. With that, I'm going to go ahead and open it up for questions.
Thanks, Kevin. Yeah, and before we do that, I'm going to have Guy make a couple of comments, and it kind of goes back. If you want to go back one more slide, I think he's going to cover. Well, that's fine. You don't need to, but he's going to cover a little bit more about how all of this really fits in with each individual's retirement plan and planning ahead for all of that. So Guy, go ahead.
Yeah, thanks, Caleb. I just wanted to talk a little bit about how here at Compass we view Social Security. And so I just start out by saying, if you can really let us know when you're going to pass away, we can really nail the Social Security decision for you, right? That's one of the jokes. But in all reality, it is impossible to try to wring the top dollar out of Social Security, because that means you need to know the future. And of course, nobody knows the future, right? When we think about some of those slides that Kevin was talking about, if you take it earlier, you're getting less, but you're getting hopefully that lesser amount for a longer number of years. However, if you wait and delay until 70, you're getting a higher amount, but you'll get it for a less number of years versus filing at 62. So at the end of the day, we here at Compass view Social Security as a tool to make your plan work, to get you retired. So only a tool. And there's a lot of individual circumstances that come up. Kevin touched on a lot of the high level things, but he also mentioned several of these areas go very deep and have lots of rules and timing and tax things associated with them. So it's really important. Again, how does this decision affect your plan, affect your situation? Because every situation is different. And that's really what's important about digging into Social Security.
Great. Thank you, Guy.
Yeah.
So we will take some questions now. I've gotten a couple that have come in. If you do have any questions, please feel free again to email me, caleb.pearson@compassiowa.com. You can also text our main line, 515-327-1020, and I'll get that here as well. So the first question that we got is, and Kevin, you can answer this one, based on when a person wants their Social Security income stream to start, how early should you apply?
Yeah, so great question. We recommend 60 days in advance. The system is really designed that 30 days tends to work, but it's certainly, I think, wise to have as much lead time as you can, particularly in this environment with the pandemic and with, uncertainty in terms of support and being able to have things happen the way and in the timing that you want. So 60 days in advance is a good mark.
I'd add something to that too, Caleb. You can have tax withholding held back from your Social Security payments. So if you know how much you're paying in federal and state taxes, that's another important thing to set up when you do set that up to begin with. So if that benefit is going to be taxable, you have some withheld.
Great, thank you. And one more thing I'll add to that as well is how you can apply. I mean, you can always call in, and right now I don't know how much they're doing in person, but via phone, definitely you can call and set an appointment and do it that way. But I've also helped clients, even with some of the advanced restricted applications and file and suspend, those types of things, if they qualify. I've helped clients do that online as well. And as long as you know what you're doing and going through that, you can do that. We obviously would like to offer up our help to do that alongside you and help you through that. And sometimes when you're on the call and going through everything, they're reading off all of these rules and disclosures, and it gets kind of scary. So having someone like a financial advisor who knows how that application process goes beside you, just to make sure that you're setting it up properly, I think that can really help. So Kevin, another question, I know I've asked you this before, but I think it's important to bring up, as you were talking about the earnings test and earned income while you're, after you filed for Social Security benefits, you mentioned the 18,240 before full retirement age, and then the year you turn full retirement age, the 48,600. I want to make a point, and you can talk maybe a little bit more about this, that only applies after you've filed for your Social Security and claimed Social Security benefits, if I understand that correctly. So, if you retired, say, in September, and up until that date, you had earned $70,000 of income, that earnings test doesn't really apply until after you've actually started receiving benefits. Is that correct, Kevin?
Absolutely correct, Caleb. Any of those earnings that you receive before that retirement date will not count. They refer to it as a special first year provision. And so you need to inform them, right? That the Social Security Administration occasionally too, that they'll contact folks in a scenario like that who, I was just helping someone who received a letter from Social Security that she owed $41,000, and it was related to some deferred compensation that she received. That came in the form of W-2, but all the Social Security Administration knew was that she received W-2 income after she started her benefits. And this amounted to something that informing the Social Security Administration specifically what that source of income was. She didn't owe a cent. She just needed to pick up the phone and contact them and let them know. It turned from a very frightening kind of situation to something that was pretty easy to resolve. To your point there, Caleb, I could earn $1 million from January up until September. And as long as I hadn't filed for my benefits, that $1 million will not count 1 iota in my Social Security early filing decision. It's what will I earn from that point through the rest of the year.
Great, thank you. Another comment, this isn't necessarily a question, but it's a comment that came in from a client that just to let people know and be aware, and Kevin, maybe you've run into this before, but you're not able to actually create an online Social Security account, My Social Security account, while you have a security freeze in place. So if you utilize some sort of service out there where you are freezing your Social Security benefit, they're not going to recognize your information until you lift that freeze. Is that something that you've seen before, Kevin?
I have. I'm not like an expert on how that works, but I've had questions and understand that that's absolutely an issue. And I think the Social Security Administration includes a way to contact them or what needs to be done in order to lift that or be able to continue.
Okay, great. And then one last question that I have here. Again, this will be the last one unless I get something else coming in here. So this also comes from a client. I'm divorced, and the last time I checked with the Social Security office, I was told that my monthly payment would be about the same if I file under my ex-husband's as opposed to my own. If he files before reaching full retirement age, would my amount increase if I wait until I reach full retirement age, or will it stay the same? There's a lot in there.
If he files early, it would not impact the spousal or divorced spousal benefit. His early filing will impact his own benefit, certainly, but the amount that's used to calculate her benefit is going to be the full retirement age amount. And that applies whether he files late or he waits until age 70. So I think maybe I missed another component of that question.
No, I think that sums it up. So if Mr. Carson, the comedian you were talking about, chose to start receiving his benefits at age 62, his 3 ex-wives will still get the maximum that they're due. So he can't try to reduce how much they're getting.
They would get the maximum that they're due they would get the full 50% if they themselves wait until their full retirement age.
Right.
They would get the maximum they're due, yes, depending on their age of filing. Absolutely correct.
Hey, Caleb, I have one more thing just to kind of bring up. In a lot of our planning experience, when we plug Social Security numbers into individual plans, we actually find that the lifetime benefit for a married couple filing Social Security and collecting it over their lifetimes is pretty close to $1 million. And that number keeps popping up again. So it's a very valuable benefit. I know it's tough to pay those taxes all those years, but it's very valuable. And going back to what you said earlier, where as it sits right now, the Social Security Administration is bringing in 80 cents and paying out $1. And so they're using their reserves up a little bit. And in that in 15 years, those reserves are expected to be gone. So we don't feel Social Security is going anywhere. We feel it'll be addressed at some point in the legislature, although there doesn't seem to be much urgency about it right now. So if nothing happens, then there's still an 80% payout. And really one more kind of insight into planning. And here's why it's so important to do the planning, because each situation is so different that sometimes there isn't much of a difference filing at 62 versus waiting to 70, because we've seen situations where actually they end up in a worse spot waiting because they use up a lot of their assets in those years that they're waiting to file Social Security. And then that permanently impairs the ability of their army of dollar bills to work for them much later in life. So again, just very important to do the planning, see what Social Security means for you, because it means a little something different to everybody.
Yeah, Guy, you brought up a good point, and we just had another question come in that I think ties directly into that, is because of the uncertainty and solvency issues that are out there, whether they get resolved or not, should clients and financial advisors include a haircut in the Social Security benefits when they're looking at the financial plan as a whole?
That would certainly be a conservative way to address planning. And I've had that conversation, especially when we do planning with the 30 and 40 and early 50-year-old segments. Hey, should we just plan on 80% of the current estimate for Social Security? And I think that's a good place to start. It's always good to be conservative and make conservative assumptions, because you can always adjust it up if the reality changes in the future, or versus taking a haircut in the future and say, oh, yep, we made some wrong assumptions back then. So I agree that might be a good decision.
Okay, great. Well, that's it for questions. Kevin, I want to thank you for hopping on and running through that. Again, for people who have been on today, I'll be sending out a recording of this. It's also going to be on our Facebook page. So if you want to view it there again or share it on there, please feel free to do that. Kevin, again, thank you for your time. Guy, thank you for your comments, and we'll see you guys next time.
Thanks for joining us.
Thanks.